Good morning, everybody. Can you hear me?
Yeah.
Okay, so what we're going to do is I'm replacing Mark Heil. This is the emerging manager panel. And what we'll start off doing is quick intros. And specifically, I'd like each of the panelists to give us 1 or 2 minutes about their company, and then we'll get into the panel discussion. Before that, I just want to make a shout out and say that I followed Jeff Hughes' work, and I just wrote a monthly letter, and I've actually done very well in terms of calling recent market moves. I think that you should take what he's saying very seriously. I think he discredits himself by talking about massive declines, but I think that the risks here, to the market are very real, and I think that people should take their equities from 60-40 to 25% cash, 25% commodities, 25% stocks, and 25% bonds. I think things could potentially get much worse. I think he's a very astute analyst. There's a lot of good work, but these processes take time. But I think right now things are in trouble. The reason I mention that is that spills over to, I think, the emerging manager discussion we're now going to have, because a lot of the trends that he's talking about are things that emerging managers will be talking about. So if we could get 2 minutes, starting with Susan Webb about Appomattox Advisory, and then I'll hit everyone with questions.
Great, thank you, Tim. Thanks, Marty, for having me here. I've run for 20 years, founded and run an outsourced chief investment office called Appomattox. We specialize in emerging managers selection as well as in private credit, so we can be hired for those mandates. My background before that was running derivative desk on Wall Street, cross-currency swaps for 5 years, and then global equity derivatives along with cross-currency swaps for 10. So I come from a trading background. Before we had the ECU and the euro, so I actually can kind of relate a little bit more to what's happening, which is finally, I think, the government starting to get out of the markets because they can no longer support it. I think there are a lot of great opportunities out there, but you do have to be selective.
I'm Paul Foley. Neeson already did a good job of talking a little bit about Akerman. I run our investment management practice, which includes really anybody who manages money for other people. Represent a lot of very large family offices with respect to due diligence on their investments. If they're multifamily offices, helping them with their regulatory overlay and dealing with the regulators. And then really investment managers of all shapes and sizes, institutional, pretty much any strategy, including retail to as sophisticated as they get. Been doing this 20 years. Our team at Akerman, there's about 20 of us spread across the country. And I also run our North Carolina office, which I started a little over 4 years ago. There was one of us, and now we have 26 people in the office in 4 years, and it's really hard to recruit during COVID. So we're really excited about that. And I was really excited about the economy until I heard Jeff talk. So there's that.
Paul, are you in Charlotte or Raleigh?
I'm actually in Winston-Salem. I never would have imagined that that's where I am. I married a woman from Winston-Salem, and I like to say I thought I was going to help Billy Bob sell his barbecue joints at Tom Joe, and it turned out, I had represented Citadel, and I worked in really big firms, and moved to North Carolina, and a few of my big clients followed me about 15 years ago, and now we have over 400 different investment managers that we represent across the country.
That's great. Well, glad to be here, you guys. My name is Timothy Smith. I'm a chief investment officer for a G4 single family office in Houston. Historically, wealth creation in agriculture and energy, as you guys might suspect. Today, we're dealing with a number of different issues, going through generational shift, which is both in terms of leadership and family engagement, as well as overall kind of trends and longer term generational perspectives. So we still do a lot of direct investing. Direct and co-investing is about 60% of operating companies and real assets. but we're using alternative investments for generational diversification, creating more of a traditional passive income portfolio. So excited to talk a little bit about emerging managers. Our trajectory in the last 5 years has largely been kind of moving into more established, kind of following other family office or institutional friends into funds. But we're looking at emerging managers and expanding in that area to be able to look for a number of different flexibilities or better terms or unique strategies. So I'm excited to hear what the other panelists have and share our perspective.
Timothy, if you'd be sure to put up your contact information and phone number in the chat space when you have a chance later today. Susan Webb, what are the hot areas in emerging managers?
Well, I think it's a lot of hot areas actually, and I think it's a good environment in particular for not passive strategies, because finally you get paid for shorting. First time in about a year, people started to get compensated for it. Two, I think there is a lot of dislocation. The prior person who spoke talked a lot about the 7 stocks, but we see underneath the surface of the other 492 stocks in the S&P, massive movement. And it's been a great environment for good stock pickers that can analyze cash flows well and the persistence of those cash flows. So I think strategies that can capitalize on persistent cash flows are the ones that are going to win. So you're seeing that a lot with private credit. And if you have put money with these private credit managers, you are going to anticipate returns of 10 to 14%, where you actually will get cash paid out to you on a consistent basis if you want it. So that's a good space to be, we think. Secondly, we're big impact investors. And I think to your point of energy and commodities, but with an impact focus, that's going to be a great area for niche emerging managers. And third, we have always been big proponents of growth. I just think you have to have growth at a reasonable price, which to me means having cash flow to fund a large percentage of that growth, because having capital to invest for that growth is going to come at a higher price. So your hurdle rate is higher. It's not that you can't achieve it, but your hurdle rate will be much higher. And we're seeing that in a lot of our growth technology investments. So those are the 4 areas that I would be focusing on.
And we're one of the first calls almost any emerging manager is going to make. They want to call a lawyer and start talking to them about, hey, we're thinking about putting this together. And I'd say over the last year, it was all private credit. I mean, private credit, and somebody wanted to do something crazy, and they don't want to have third-party valuations. They want to offer it perpetually. There's a lot of real risks associated with all of that. But I'd say in the last month, what's been really interesting is, for the first time in a long time, we're hearing a lot from potential hedge fund managers, folks who want to trade stocks actively. So that's consistent with what you're saying here.
Yeah, we've been looking at a lot of different managers in general. Private credit's definitely been an area of interest for us as well, in part because we're still taking a lot of direct investment risk through kind of a private equity or tech-enabled private equity approach. So we have been continuing to look at a number of those different sector focuses. I think that what's been drawing us to emerging managers that's been interesting versus some of the others, of course, we're real active in the overall ecosystem within private equity and direct investments. We don't do a lot of, say, fixed income or soft management or general management in-house, so we are using those outside components. But of course, with emerging managers, in a lot of cases, we may have more flexibility over negotiating terms or even participating in a GP, depending on what the situation is. Where we do a lot of co-investment with other family offices, it's kind of our preferred method. A lot of other family offices are now stepping into and helping support or sponsor emerging managers, helping them get scale, things of that nature. And so we're looking at that as obviously a passive allocation, but being able to enter into and get different terms and still kind of follow some of those similar themes.
So I have some follow-up questions for Susan Webb. Hang on a second. On this private credit area, what are the risks there to that sort of investment?
Yeah, I think if you get with too small of a manager who doesn't have a lot of experience, they're not gonna appreciate what a cram down is. Cause we haven't seen a lot of that. And so I think you wanna be with someone who has a reasonable distressed group that can do workouts, because they are gonna be taking over a lot of these private equity sponsors' investments. So I think you'll get a lot of money, but you need to focus on who is running that private credit. Are they doing a unitranche to control it? Who else is in the deal and how is it structured? And do they appreciate that? Because there are a lot of groups setting up businesses that don't really understand what a cram down is. And I think secondly, scale does matter in this market. So you know, it is a strategy that if you know a manager well and he's really experienced, great, go with him. But I would be going with a fairly larger group, kind of between 2 to 5 billion, would be a sweet spot where you really get the maximum alpha out of the manager, not just generic returns like an index, but still have a group of people that can execute in capturing the maximum value for you as an investor.
Paul,
Yeah,
Paul,
we
would
represent.
Paul, please, could you talk about the risk in this area and what your thoughts are?
Sure, and that dovetails nicely. I represent a number of multi-billion-dollar private lending clients that were doing it long before it was cool. And those are the folks who you probably want to be doing this with. We've helped them with taking over companies that they didn't even necessarily know how to run, you know, and they're debt guys. And, you know, that's an interesting thing. Now we're starting to see, you know, the $100 to $700 million private credit guys. We just helped last month take over, you know, one of the companies in which they had lent money to, and you know, we're looking for a seller and that kind of thing. But going through that process was new. They had really never even been through that process before. So folks who've been doing direct lending for a long time and actually understand it, I think is huge. I don't know that it's a great strategy for an emerging manager. It's not something to just jump into and dabble. What I see is a lot of these emerging managers, and I touched on it a minute ago, they want to do an evergreen structure so that they can recycle capital, but they also don't want to pay the price to actually have valuations when people are coming in or out of the fund. And there are enormous risks associated with that for everybody involved, because, you know, if you're carrying a loan at par and you let people in and out of the fund at that price, the next week the borrower defaults, you know, everybody's going to be looking at everybody else. What did you know? When did you know it? And so they say, oh, I didn't know it was about to default. Well, okay, well, why weren't you doing your job? So not being able to have third-party pricing is a really big piece of it. But even if you have third-party pricings, it's like, what did you know? When did you know it? And there's a reason why the typical private equity structure of, you know, closed-end fund where the investments burn off, that works for private equity, because these are really hard to value companies. And that's the biggest risk that I see on the private credit side.
I'd like to switch. And Tim, can you talk about what you see in the commodity space? I know Jeff was pretty keen on gold, but you know, that's more your ballywhack. And also, what's going on in the energy space? Where are you investing, or where would you want to be investing, and what kind of emerging managers make sense in that regard?
Yeah, so obviously we're in a really unique time economically. A lot of interesting headwinds being discussed in that early keynote that we had. You know, energy prices, of course, are you know, looked at upon in terms of impacting a lot of different things, but in the broader sense or macro sense, people are looking at oil prices and not really seeing how that could be a major detriment to the economy. Obviously, prices have subsided now, seemingly calmed down. We also didn't see a traditional geopolitical risk adjustment when the Middle East conflict accelerated. So we're really in a different environment. As he was indicating, demand now hitting peaks. So you've got a lot of those types of situations, but any kind of supply disruptions could see significant price changes. And, you know, if you go back, obviously, through history, at least 10 out of the last 11 US recessions were predicated by really high oil prices. So when people are trying to evaluate, we're not market timers, we're not market pickers, we're long-term investors. And we are real asset and private equity driven in a lot of cases. So that's one thing we're looking at from the big picture. touching briefly on metals and mining, we're looking at more niche markets on an individual basis for managers or for direct investments. It has a lot to do with other specialty rare earth minerals, things like lithium and cobalt, which we do believe are ongoing high demand and growth trends over the next 10, 20 years as we see electrification take more shape, although there are a lot of challenges in that space. In terms of working with the right managers, I think that for us, we are always going to recognize that we know, we don't know, we don't know. So even though resources are going to be important, dealing with the right type of emerging managers, and a lot of times that comes in through co-investment too, where we're maybe leaning on another manager from that perspective. So we've been doing a lot of that. Within the domestic market, we're largely a U.S. focused energy group. There's lots of low-hanging fruit, right? We went through the shale boom and crash, and ultimately we have more data than we've ever had before. So it's not really an equation domestically about where or how, it's more of a manufacturing equation. So we can get into the right deals, leverage the right hedging, and so on. So I think emerging managers have a unique perspective here because there's a lot of unique opportunities, in some cases, smaller opportunities in this climate that the bigger guys just aren't tactically able to take advantage of.
That's great. I'd like to go back to Susan Webb. You started out talking about shorts, and Jim Chanos just got out of the business, which probably is a good sign because it was so hard that there are few. But is this just typical long-short hedge funds that you'd recommend, or what about derivatives and quantitative strategies? How would you recommend shorting the market, and what emerging manager strategies are attractive to you if you're worried about markets?
Yeah, I think you can find smaller emerging managers that are quite good at shorting single stocks and then in and out of different index options. They're quite a good short only managers in the UK, in fact, that we work with. But the big caveat is that these aren't the big managers. You're not gonna, one of the reasons why somebody like TCI is just long only is because he can't possibly short a $30 billion fund because he's just become an index of 5 to 10 stocks. So when you're working with an emerging manager, you're really capitalizing, I think, on the alpha that they generate from their shorts. And some of them can get as big as 2 billion, depending on the market cap of the underlying equities. So we see this as a great opportunity right now.
Paul?
Yeah, that makes a lot of sense there because we see a lot of the small managers able to actually move swiftly in the market. If you're a large multi-strat hedge fund, how are you really going to effectively short the market? You can get squeezed pretty easily. Speaking of all these headwinds, one of the things that we are seeing is just completely non-correlated types of investments, and that's where emerging managers really excel. And a lot of those now are around legal strategies. We're starting to see, the funding of IP, quote unquote, trolls, and the ability to participate in, funding those and reap the benefits of those actions. A lot of different types of litigation finance, and there's been some opportunities in Arizona where for private ownership of law firms, and that's a really interesting backdoor into potentially participating in the real upside of a lot of these, litigation actions.
Yeah, so a couple interesting topics there. Certainly not an expert in the long-short strategy internally, but the overall perspective right now that we have in the markets is still pretty bearish. I think we share a lot of the sentiments, and so does kind of our family office club. But a lot of it's more about managing risk for us and downside. So we're not trying to capture the bottom or find the perfect stock to short, for example. So those are some unique things that we are looking at. And certainly cautious from that perspective. You brought up a couple interesting good points about private credit litigation finance, other components of that have been coming up. We see a lot of those things as, potentially, kind of recessionary proof type of strategies. So we are trying to look for a little more stability. For us, that's, looking at the commodity risk, looking at overall exposure, and, to take those types of things, finding more segments within our portfolio that we feel are anti-recessionary or at least a hedge against that, or have that baseline of consistency, with the right strategy, and so on. I'll go ahead and, right, Marty?
I would just say one more thing, is that we are seeing great opportunities as a decorrelated but profitable private credit strategy in MPLs. And that is very profitable and really is a winner if you can get the right manager. And the second thing that I think is re-emerging, which a lot of people have forgotten about, is ABS arbitrage as a strategy, which again, people have stepped away from because the government was controlling the mortgage market as well. And that is starting to slowly diminish. So I think there are a lot of strategies that people have forgotten about as ways to make money that are coming back. And as you know, Citadel continues to mint day after day after day. So if you really do know what you're doing as a large market neutral or arbitrage long-term hedge fund like of that type, or CTAs even, you can make money.
So just a quick question for Susan. I'm just gonna jump in here. So, so a couple of things. Do we just run back the 2009 playbook, do you think? Is that like a valid strategy? That's my first question. And then my second question is, with regards to credit, should we just look at places where banks are withdrawing? Like, I mean, I saw the greatest advice, I had a guy from Texas, an Indian guy, phenomenal entrepreneur. He bootstrapped his own company, $400 million in revenue, calls me up and says, look, $400 million revenue, I own 100% of the company. And he said, but I have a $100 million line of credit with JP Morgan, they just pulled half of it.
Yeah.
And I have $30 million in the bank, which is pretty good for a company. I mean, the average 25% is not, for a private company, it's pretty good too. He's like, I come up with $20 million in 6 weeks.
I think you highlight a really important point. One, the big money sitters are definitely cutting costs because they're gonna increase regulatory control over them again and capital requirements. And the cost of monitoring a small loan or whatever is just too high. And so they're throwing people out again, because they've done that repeatedly.
Yep.
So all the money sitters are throwing out small, I think, companies already thrown out money managers. So what is also happening at the same time is, of course, properties being marked down. It's probably gonna be marked down between 20 and 25%. So the regional banks have less ability to step in and fill that void of lending credit. And therefore you can come in private credit and be a good lender to some of these small companies. They're doing, I think, a great job and are being left high and dry, thanks to a variety of factors.
But what's the expected difference in, the credit?
Yeah, you're gonna
The
make
banks
400
and-
basis points. You're gonna pay 400 basis points more if you're a small company.
So if you're an LP, you should be looking for firms that are printing 400 basis points
Yeah,
more.
more. I mean, you're gonna get paid for that illiquidity premium, for sure, in this market, but it is illiquid, right? But you're gonna be paid for it.
At least, and I mean, to get to a 14% return, you're paying some real interest rates, and then, if somebody can get a bank loan, they should get a bank loan. And this is much riskier, and a lot of these are gonna default. And so being prepared and making sure the manager actually has a strategy is important.
Just to echo what Marty, you were saying, we have a lot of operating businesses, we invest in a lot of operating businesses. We're not a levered buyout group, so we always are using low leverage, but we do a lot of service-based businesses, industrial-based businesses, so bonding, working capital needs for long lead times on projects. The banks certainly are not playing ball at all, even the big guys, even on companies that have municipal contracts or government contracts. And so we're, in those cases, if we're looking to just add debt, since we're typically the equity, then we're having to head out to other private credit managers in a lot of cases to get the size that we need. And I think we'll grow into some of those, but they're, right down from the big guys down, not even just the regional guys. They're all, I think, similar situations. They're offering much, much less traditional commercial credit, but at the same time, paying that premium from the other side, makes a lot of sense in this environment.
But to your question of are we back in 2009? Absolutely not. There's much less leverage out there than there was back then, by far, yeah. And because remember, there was a lot of bank leverage, just not there.
Right.
You
But there's a
do-
lot more private credit.
Yeah, but those are smart people that did a lot of that private credit, and it's only 1.5 trillion. 1.5 trillion in high yield, 1.5 trillion in private credit, and only 2/3 have actually been drawn of those funds. So I think there's a lot of flexibility there. To me, the real risk is going to be with a lot of these sponsor deals where you have this stuff leveraged 7 or 8 times. So I think not yet, but soon you may want to buy some secondaries.
I got a quick comment or question, Paul, or for the whole panel. It seems to me commercial real estate looks to be a potential huge collapse over time. And secondly, what are your thoughts on China? And does any of that reflect back on what you're seeing in emerging managers? Okay, Paul's laughing. So go ahead, Paul.
Well, on commercial real estate, anytime I hear anybody talking about a huge collapse or something about to happen, I just think of a real opportunity. That there are real opportunities there. I have no idea what they are, but they're definitely there. It's gonna change a lot. Just kind of circling back on the 2009 redo. Yeah, there's a lot of private credit out there, but it's not all cross collateralized in the way that it was in 2008 and 2009 with the credit default swaps. And there was so much systemic risk there because everybody was interconnected. Here, you've got all kinds of different players, but they're not nearly as interconnected as they were. And I mean, it's a very different thing. So there could be a collapse.
Also, there are no forced sellers, right? Like if you're a bank, you've got to get your capital ratio back in line. You had to sell. And you're a private credit fund, you don't have to sell. And what we're seeing is commercial real estate guys are cutting deals in New York, okay, pretend and extend and restructuring and reevaluating. A lot of these people are families, okay, on the real estate. And you'd be surprised how many of them really don't leverage their family buildings, and they're not going to sell in a down market. They just will not spend as much. So I think it's not going to be as bad, at least as a lot of people think. But as you said, Paul, I think there are a lot of great opportunities for opportunistic real estate guys.
There really are. Now, getting to your other question, Tyson, on China, I have no thoughts there at all. So I'm going to turn it to somebody smarter than me.
Tim?
He didn't mean me, by the way. Just on the commercial real estate outlook, I mean, we've been extremely bearish for quite a while. Trends obviously being one of them, office space, just a total vacuum, retail continuing to decline. And with these new interest rates and a lot of the upcoming redeterminations or need to refinance a lot of the big commercial real estate, I think there's a lot of collapse coming within that particular segment. And I haven't fully studied the counterparty risks as well as you guys might have, but we're definitely very negative. One thing I'll say about that we've heard recently from several other $1 billion plus family offices, in a lot of cases that have significant office exposure. Now this would be like LA or somewhere. They're just letting these buildings go already. They're not even waiting. So it's a risk question now to say, well, is there even a chance to do something? A lot of people are talking about rehabbing commercial space into other things. Also very challenging because a lot of those buildings are older and they're not going to have the same infrastructure internally to be able to support those kind of conversions. And retail is just, malls and retail space seems to continue to go down. China is a big wild card in my opinion. That's about what I've got. Marty?
Susan, this actually gets back to your mention of secondary. So I think we've been in a recession for 3 or 4 years. I think we've just had a slow motion secular recession where different sectors are in recession, but we're being pulled along by Google and Facebook and other tech, right? But so you mentioned secondaries. The difference between 2009 and today is that there are so many more secondary funds that are already in existence. I mean, we
do a new one for sure.
In 2009, there was probably $5 billion secondary funds. Now there's 20, right? And I think a lot of stuff is being covered up by secondary transactions you don't hear about.
100%.
Right. So I'm wondering, when is secondary's moment? When do those guys run out of gas and they got to go to the market?
We're looking at new secondary funds
So
that are
I'm
just
asking
starting to raise assets, because we think there's been, just like there can be in credit and private equity, a lot of pretend and extend. But, again, I think you're better off in smaller niche guys doing this space, who are really looking at the company and figuring out what's the potential for the company. But I hear what you're saying about this kind of rolling recession, sector by sector.
Right.
I think the economy's a lot weaker and has been for, going into 2020, really. We all
Yes.
thought it was gonna go down, then COVID took it down worse, right? And then it was only this huge spend by both administrations that sustained the economy and created this inflation trajectory because of this imbalance of supply demand that they created. But I think I still think I'm an optimist. I think I'm a Steven Pinker reader. And the economy continues to do better in the US as long as we can control regulations in this country and they don't become so onerous that people can execute on plans and ideas and have access to credit. I'm pretty positive.
I'll give you a great example. It ties into Tyson's question about China. So 2 months after the Russia-Ukraine war broke out, this guy calls me and says, I'm running a secondaries fund. We're buying every China and Russia interest we can find. A lot of Russians and Chinese invest in the United States. He says, we're buying it at 75% discount. Right?
Right,
For
China and Russia stuff?
interest, for their interest in American
Oh,
funds.
okay, in the US.
It was mostly venture stuff, right? I mean, there's some fantastic Russian investors in venture, right?
Right, yeah.
Right? I said, so how much are you deploying? 10 million. I said, you have to raise 100 million in 6 months or somebody else will steal your strategy, right? I mean,
Yeah.
so,
Marty.
yeah, Russell.
So, I'm Russell Deacon, I'm a family office. So in emerging markets, a couple of things I want the panel to address. So we've been doing a lot of emerging market venture capital as well as growth capital funds. We've decided, I want to get your opinion about if you're seeing good venture capital, growth capital opportunities specifically. And then in terms of the foreign markets, we believe that it makes sense now the next 10 to 15 years because I just came back from a conference. Last year, 58% put China as the emerging market. Now it's down to 3%. But we believe that India, because of the cash flow going in, there's going to be more liquidity. We did a due diligence trip and we've decided to invest in India as the emerging market for 10 years or so. So I'd love the panelists' comments on what I just put.
Sure, I can get started on that. Certainly, there is, I think venture is a good example of, new managers, new opportunities. I think, if you're buying secondary LP interests and things like that, then there's a lot of opportunity within current venture funds or current vintages, I should say. Currently, obviously in this climate, we're dealing with lower tech valuations, a lot of other headwinds that are still affecting that. That sets up for a good 5-10 year outlook from a venture standpoint. I'm not a international expert by any means, so we rely on outside expertise for that. Personally, I'm pretty bullish on India as well. I think there's a lot of opportunities there. I think there's still a lot of risk associated with where we're at today. So as we're looking at more of those strategies, it's kind of over the next 1-2 years as we see certain things change. We're not trying to necessarily be the first ones in on anything these days in terms of our risk profile. I think that it's in this climate, particularly for us, and I'm sure similar for you guys, you're looking longer term. You're not trying to take any more risk than you need to. You likely have or may have higher risk things that you're doing directly that kind of account for that. So we're looking for things that we think are stable at this point and then have a longer term upside perspective. But venture is an interesting climate right now. Just there's a lot of opportunity out there. And we certainly don't have the venture expertise in-house, although we like to apply it to our private equity portfolio. So when we are looking at managers that have that type of expertise, we're looking for people who have been through cycles before, people who certainly have an ability to manage their current portfolios, looking at how they're dealing with those types of things. But without a capital market to exit to, they're really only exiting the strategics in this particular climate. So trying to understand what they've done in the past and what their ecosystem looks like, that's going to be really important to us.
We've invested in India quite a bit for over 10 years. And I would say a very key aspect is who are your partners in the deal? And you want to be totally aligned with one of the 10 wealthiest families. If you are not, you will not make money in India.
We're definitely seeing a lot of very interesting emerging managers on the venture side. Ventures continue to be hot with emerging managers throughout the last 2 years, even though, you talk about all the doom and gloom. But when you talk about pretend and extend, and not quite secondaries funds, but basically every venture capital fund, large venture capital fund and large private equity fund is effectively just buying the deals from other folks, pretending and extending. A lot of them have serious capital that they need to deploy in order to make their fees, in order to justify their existence, and keeping it all together, whether they're buying from their previous fund or somebody else's fund. There's a lot of incentive in doing that. So there's some pretend and extend there.
And I like actually the UAE. I mean, we're just spending money in the Middle East. That's, and a lot of the people in the Middle East are the ones that go into India and are doing the consumer sell into there, and they're better equipped, I think, to kind of make money out of the Indians because the way they do business. So, I like the Middle East a lot.
One follow-up question I'll just say in terms of kind of the risk side of it, like you pointed out, they're trying to hurry up and rapidly deploy the capital because that's how they're going to get into their fee structures and so on. We saw a lot of this when oil and gas prices collapsed after 2015. There was so much dry powder that literally funds were just trying to buy, and they were paying more than they should because they needed to deploy that capital. So I think venture is probably a similar scenario where they're looking at deals, they want to beat the next guy, they want the secondary, and I think that you got to look at how they're deploying, what is their addressable market in terms of their deal flow and their deal pipelines, and trying to understand, are they going to be potentially merging into a conflict in their investment strategy by buying things that maybe have a different risk profile than what they would normally do.
What are you both seeing in biotech? What do you think of that space?
A lot less interest right now.
Oh, really?
That's from new fund startup or just on an ongoing basis, a lot less interest. But I think there's enough dry powder to push through a lot of, there's years of dry powder out there to push through these deals. And if you were marking them to market, they would not be getting done at these valuations.
Well, a lot of people raise huge rounds, right? At like Series A of $20 million or more, $40 million, and you're like, what is your Series B? And then it's like, well, I raise 50 million, or it's very difficult. So that's why I said it's almost impossible to raise Series B right now in healthcare. So
yeah, it's not surprising. And one of the things that I'm seeing for the first time in 20 years is investor defaults. And it's not across the board. It's always one investor with a particular sob story. And we try to figure it out as the fund manager and what we can do legally to get them bailed out. There are real opportunities for secondary investors in there because, if the lawyers have written the documents right and you're a defaulting LP, you lose it all. And so you might have to take a default, discount 50% or something very significant.
Yeah, we're seeing that too, and I think a lot of it is because a lot of people were anticipating an IPO, and then the rug got pulled out from them on all that, and so they don't have the cash that they thought they were gonna get, and yet they already committed other funds. Yeah.
Well, I'd like to thank the panel.
Well, I have one more comment, Tyson.
Okay, go ahead.
Are there any other questions here that for the audience, for the speakers? Hold on, let me just find out. Look at the online. Actually had some comments. So one of the issues with investing have been that it's, from a tax point of view, it's been better to borrow than to spend,
Right.
cash you might have or whatever on investment, right? Or to take income, right? Let's say that you own a company and you have assets in the company, you can just cash it in and put it in, you don't want to do that, it's a tax thing. So it's better to borrow, if that's whatever you have. Liquidity is actually your enemy if you're an investor, right? So I think a lot of people may have become over leveraged as a result, and they pulled back, right? So what are you seeing in the venture space right now? Maybe talk about venture, because it seems like every venture capitalist I run into is having a hard time raising money.
Yeah.
And some of the really good ones.
Right, the funds, the new funds have been cut at least by 50% more coming in, if not more. So I actually think again, that's something I wouldn't rush into right now. So, but I think there's gonna be good opportunities in venture, but not right away.
I mean, the one place we see significant allocations being made to venture, first-time venture managers is if they're diverse managers. And there are major institutional programs that we're negotiating with from major banks and other Fortune 500 pension companies that are very, very much putting assets there. I mean, $50 million to a first-time manager. I just finished one a couple weeks ago, and you're like, hold on, what's going on here? It's definitely that there are some real sectors where you can raise some money.
Also, I think, and again, an impact, which we didn't talk enough about, but we are definitely seeing great opportunities there for venture and for startup funds.
Thank you again.